another voice to talk about how he's approaching India now. Arvind joins in to talk about what he took away both from the budget event and generally what's been happening globally. Arvind, good morning. Good to see you in. It looks like there's quite a bit of risk aversion on the screen globally. What have you made of it, and do you foresee more damage for equity markets like India in the month of March?
Well, I think we've clearly turned the page, at least for the short term, from everything is rosy on a global basis to suddenly starting to see the cracks that were being ignored. And I guess the Italian election was the first thing that caught the market's attention. Secondly, although I'm surprised that people are surprised, the impasse on the U.S. Budget situation with the sequestration is also causing some nervousness, although I think the market was fine with it on Friday. It wasn't like it was expecting a magic solution over the weekend. So I think the market's digesting that. But now, there's news coming out of China, which suggests that the Chinese bounced back from extremely slow growth in the first half. And forget the official GDP numbers, but you had some very weak growth in the first half, and it seemed to be bouncing back towards the end of the year. And there are signs that, the government is having to clamp down on property and other things are not looking that strong. So, you've got three major legs of global economic, if you call it the economic, I guess, stool or chair. Maybe it's got four legs, and three of those legs are have some wobbliness to them. It does cause some amount of risk aversion, which I think could continue. And so I think there is a bit of a short-term trading risk to global markets and therefore to the Indian market too.
Arvind, morning. What's the bigger problem according to you? I mean, just to take away China for a bit and focus on the US and Europe, between the Italian uncertainty and the sequestration problem which has cropped up over the weekend or got confirmed over the weekend, which one of these two do you think has the higher probability of driving a phase of risk-off in global equities?
I would say, maybe the Italian one is bigger, but I think they both are part of the same problem. The problem is not governments, the problem is voters. The voters are not adjusted to having to tighten their belt and to live, within the means of the budgets. And therefore, they're trying to find easy solutions in Italy by the amount of votes that both, the fringe party and Berlusconi, got. It shows that the voters are not happy with the formula that has been proposed, which is continuous belt tightening and and trying to live within the means through fiscal tightening, and that is not being looked at favorably. And same way the debate in the U.S. The president and the Democratic Party have taken from the election that we don't have to really fix entitlements, which is the long term. I think almost any budget observer would agree. But the argument has become, are the rich paying too little taxes? So again, it's taken away from what needs to be the focus of what the fundamental issue is. So I think maybe the markets are starting to fret that, this kicking the can down the road with the central bankers providing the palliative of easy money is not quite as, painless, and therefore growth is going to remain challenged. And as you get these kind of, bumps in the road, we are reminded again that growth is challenging and financial markets may be willing to forget and forgive for a while the central bankers print money. But eventually, this does affect, earnings growth and therefore market expectations of, optimism about, about earnings growth numbers and what valuation they're willing to pay for companies.
What about India? It's become an underperforming market in 2013 so far, and the budget did not do anything to reverse that underperformance. How much more downside do you think is there in Indian stocks?
Well, I think India probably overshot on the upside in 2012 and very early 2013, because I think there was a bit of a euphoria about how much policy would magically fix things. And as we are finding both from the economic data and from the policy decisions, including the budget that came out last week, there are no easy magic wands out there. So the government is raising diesel and fuel prices in general. It does reduce somewhat the subsidy burden, but it causes some inflationary pressure. It hurts consumer demand because you're switching, from burdening the government to burdening the consumer. So consumer demand is slowing down. So, the GDP growth, there doesn't seem to be a magic bullet as yet to turn that around. So you've got the issues with, with the GDP growth and therefore the earnings growth. you've got still, risks that inflation is not going to be as quiescent, which means that RBI is somewhat limited in how much they can do. I think they clearly are concerned about growth, so I'm more willing to maybe act more favorably and be more, more benign, even though inflation is probably still higher than what they would like from a long-term standpoint. But even then, there's only so much they can do. So I think there are, the idea that somehow, and I think, the government is maybe partly responsible in its roadshows of selling investors on the India story. The reality is, as the budget showed, there are no easy magic bullets out there to fix the growth problem. So I think Indian market could also continue to drift sideways to lower in the global risk off. I don't see a big crash coming, but I think, for the bull story to resume, you need to see some good news. And the only good news I can find is that, crude oil has pulled back from the high of 110s back to 110. So that does help, but India has never been negatively correlated to oil, because if oil is going down because global growth is looking slow, it doesn't necessarily help the Indian market.
How would you quantify it, though, in terms of how much more downside risk you see for the market, Arvind? We've lost quite a bit of ground. Would you say we're somewhere near the end of the selling pressure, or do you think India's got a rough couple of weeks coming?
Well, again, I guess your guess is as good as mine on the next couple of weeks, how the news flow shakes out, whether the Italian, left and right managed to form a coalition government and kind of managed to stave off elections for a few months, and that caused a bit of a relief rally. Whether the U.S. sequestration noise continues, but there is another issue coming up towards the end of March, which is the government will shut down without extending the government's budget authority. Both sides are talking about extending that, so there's no government shutdown, even though there'll be some cutbacks as a result of sequester. So there's enough, positive and negative noise that can come that the markets could bounce around. But I would say in that backdrop, India is probably more buffeted by global news than anything coming out of India specific that is likely to be meaningfully relevant over the next 2 weeks. In which case, I would say that, the Indian market could pull back, another, we could go to 5,600 on the Nifty. That certainly technically looks like a level that could happen. But this becomes more, a technical call than a fundamental call at this point in terms of short-term trading action. Anything more than that in terms of an Indian market pullback would involve a much more dramatic global risk-off, which would be caused by, either the U.S., budget side on the government continuing, to operate, that breaking down, or the Italian party is completely failing and, having to have a new election and creating more turmoil in Europe. So, you could have some things that could cause much more meaningful risk off on a global basis, in which case I think, the Indian markets could have slightly more downside than what I'm talking about. But, I think a 5-7% downside is probably my reasonable case in terms of, where we can go from here in terms of global risk off.
Always good getting your thoughts in, Arvind. Thanks very much for joining in this morning, though.